All right, let's talk about bonds. But we're going to do it a little differently. We're taking our cues from the world's most chilled out animal to understand one of the most important parts of the financial world. Welcome to the Capybara Guide to Bonds. You know how it is, right? The markets can feel like a chaotic jungle. Things are always jumping up and down. But what if you could be more like a capybara? Just unbothered, relaxed, calmly floating in the water no matter what's happening on the shore. Well, that's kind of the role bonds are supposed to play in your portfolio, a source of stability when everything else is going wild. So, here's our game plan for this explainer. First, we'll get straight to the point. What even is a bond? Then we'll navigate the 5 biggest risks you need to know about. After that, we'll learn how to decode credit ratings, compare individual bonds to bond ETFs, and we'll wrap it all up with the key takeaways you can actually use.
Okay, let's dive right in. At its heart, a bond isn't nearly as complicated as it sounds. Just think of it as you, the investor, loaning a little cash to the big financial pond.
That's really it. A bond is just a loan. You give a company or a government your money, and they give you a promise, an IOU basically, to pay you back in full down the road. And as a thank you for letting them borrow your money, they pay you interest payments along the way. You're the lender, they're the borrower. Simple as that.
Now, even the calmest pond has its currents. And in the bond world, these currents are the risks. Now, they're not necessarily dangerous, as long as you know what you're looking for. So let's talk about the 5 main currents you absolutely need to be aware of.
The first one, and honestly, if you only remember one risk from this entire explainer, please make it this one. It is by far the most important. We're talking about interest rate risk. This is the big one.
So how does this work? Think of it like a seesaw. Let's say you buy a bond that pays you 3% interest. But then the market changes and new bonds are being issued that pay 5%. Well, why would anyone want to buy your old, lower-paying bond? They wouldn't, unless you offered it at a discount. To sell it, you'd have to lower the price. And that's the crucial point. When market interest rates go up, the price of your existing bond goes down.
And this is what you'll hear all the experts talking about. It's called an inverse relationship. It's a fundamental balancing act. One side goes up, the other side has to go down. You always have to keep that in mind. Okay, what about the other 4? Well, there's reinvestment risk. That's when your bond matures, you get your money back, but now you have to reinvest it when interest rates are way lower. Bummer. Then there's call risk. This is when the issuer decides to pay you back early, usually because rates have dropped and they want to refinance. It's great for them, but it cuts off your steady stream of payments. Default risk is the easiest one to understand. It's the scary thought that the borrower just can't pay you back. And finally, there's inflation risk, the silent portfolio killer. This is the risk that the interest you're earning isn't even keeping up with the rising cost of, well, everything.
So how in the world do you manage that default risk? Well, a smart capybara checks the water quality before jumping in, right? For us, that's what credit ratings are. They're a quick and easy way to check the financial health of the company or country you're about to lend money to. At the absolute top of the food chain, you have your AAA-rated issuers. Think of rock-solid countries like Germany, Switzerland, and Australia. According to S&P, these are the safest bets out there. The water here is crystal clear.
And then you've got the other end of the spectrum. Issuers rated SD for selective default. This means they've already failed to pay back some of their debts. As you can see from these examples, investing here is swimming in much, much riskier waters. So here's a little cheat sheet to make sense of it all. There's one critical dividing line that pretty much all investors watch. Anything rated BBB or higher is called investment grade. It's considered a reasonably safe bet. But as soon as a rating dips to BB plus or lower, you enter speculative territory, or as most people call it, a junk bond. That single line is the industry's main indicator for separating relative safety from much higher risk.
So you want to get in on the bond action. How do you actually do it? Well, you've got 2 main choices. You can buy an individual bond, which is like our capybara chilling on a single log, or you can buy a bond ETF. Think of this as joining a whole float of capybaras on dozens or even hundreds of logs all at once. The big advantage? Instant diversification. You're spreading out your risk.
But, of course, there are trade-offs. An individual bond, well, yeah, you're not very diversified. But once you buy it, there are no ongoing fees.
A bond ETF, on the other hand, gives you that incredible diversification right out of the box. The price you pay for that convenience is a small annual management fee, plus maybe some commissions when you buy or sell, because these things trade on an exchange just like a stock.
But hold on, there's a little twist here you really need to know about. Not all ETFs are what they seem. Some don't actually buy and hold the bonds themselves. These are called synthetic ETFs, and they use complex financial contracts to just mimic the performance of an index.
It sounds crazy, but here's how it works. Step 1, you give them your money. Step 2, instead of buying the bonds, they buy a totally different basket of assets to use as collateral. Then, and here's the magic trick, they go to a big bank and make a deal. They basically swap the performance of their collateral for the performance of the bond index you want to track. The hidden danger here is something called counterparty risk. It's the risk that the bank on the other side of that deal goes bust. If they fail, your ETF could be in serious trouble too.
Phew! Okay. We've navigated the currents, we've checked the water quality, we've looked at single logs and entire floats. Let's bring it all home and distill it down to the essential wisdom of the capybara. What do you really need to remember?
Okay, here it is, the capybara's wisdom. Number 1, a bond is just a loan. That's it. Don't let the jargon scare you. Number 2, always know the 5 risks, especially that seesaw effect with interest rates. Number 3, use credit ratings as your quick and dirty guide to an issuer's financial health. And finally, number 4, bond ETFs are a fantastic way to get diversified fast, but you have to do your homework and understand exactly what's under the hood, especially if it's synthetic.
Look, understanding these principles isn't just about financial jargon. It's about giving yourself the tools to find that calm, steady presence in your own investments, even when the world is going crazy. It's about finding stability. So, I guess the only question left is, are you ready to be the capybara of your own portfolio?